Hello again, Apple entrepreneurs. You already know how much profit you make on paper, but do you ever wonder where the cash actually goes? Today, we'll unwrap the cash flow statement, the third big financial report every business needs to stay alive. First truth moment. Profit and cash are not the same. We discussed that already and we'll elaborate again. In our Apple shop, we once had a $30 profit, yet the bank account barely moved. Why? Because we record sales when earned and costs when incurred, even if no money moves that day. You can have profits and still sit on a bank account without any cash. That's why the cash flow statement is important. It tracks the actual dollars in and out of the bank and organizes them into three buckets. Operating cash flow, for example, sale of apples and receipts from customers, payments of wages and payments to suppliers. Investing cash flow, buying or selling big assets like delivery trucks. Financing cash flow, receiving and repaying loans, contributions of capital into equity, payment of dividends. Together, they result in a net change in cash. You can think of operating cash flow as day-to-day breathing of a business. Operating and investing cash flows together are often referred to as free cash flow, and now the important metrics for the businesses. Let's follow one Apple sale step by step. Let's imagine we sell on credit. Our customer pays later. We record revenue of $60. No cash yet. A receivable is born. Customer pays later. Receivables disappear. Cash increases to $60. Please notice sales and profit were counted upfront. Cash arrived days or weeks later. Now flip it. We buy apples from our farmer on a 30-day term. Inventory increases by $30, but cash doesn't move today. Accounts payable appear. We are financed by our farmer. Remember, no cost and P&L until we sell the apples. When we finally pay, cash is reduced by $30 and accounts payable are settled to zero. Operating cash flow adds these inflows and outflows together, plus tax payments and interest to show if daily business is feeding or starving our bank balance. There are two options to present operating cash flow, direct and indirect. Direct cash flow means directly recording cash receipts from our customers and payments to our suppliers, employees, etc. It will look like this: receipts from customers, payments to suppliers, payments for transportation, payments for wages. All these add up to operating cash flow before taxes. Now payments of taxes. And you're getting to operating cash flow after taxes. However, most companies present cash flow using the indirect method. This method allows you to see what exactly consumes your cash resources. Here you start with net profit, and the concept of working capital plays a vital role. We briefly touched upon it in previous lessons and will analyze it in detail later. In our Apple business, that would be inventory, receivables and payables. If you add them together, you will get to net working capital. If it's positive and increases, that has a negative impact on our cash, as that means we are waiting too long for our customers to pay or to sell off the inventory. The indirect cash flow looks like this. Start with net profit from the income statement. Add back non-cash expenses like depreciation of our truck. They reduced our profits but never touched cash. And now adjust for changes in working capital. Start with inventory. If it increases, you subtract cash. Yes, you bought inventory and spent money on it, and your cash is tied up in stocks. If it decreases, you add cash, as you have sold inventory. Now receivables. If they increase, you subtract cash. A customer owes you more. If they decrease, you add cash. A customer paid you. Payables. Here it is the other way around. If they increase, you add cash. You didn't pay your supplier, you saved cash for now, and supplier is financing you. If they decrease, you subtract cash as you paid your supplier. After these tweaks, you land on net operating cash flow. Now let's move to investing cash flow. Investing cash flow answers the question: how much did you spend to grow our business? For example, we buy a new delivery truck. Such investments are often called capital expenditure or CapEx. Totals can swing a lot between years. Big negatives aren't bad if you're investing into the future of the business and it will generate returns above this investment. And of course, after a few years you may decide to sell your truck. Then you will have a positive investing cash flow. Now, financing cash flow. Financing cash flow shows how you raise and return money. For example, Bank lends you $1,000, plus 1,000. You repay 200 of that loan, minus 200. You pay yourself a $100 dividend, minus 100. Investors and lenders watch this section of the cash flow to see if your growth is debt-fueled or self-funded. Add these three types of cash flow and you get to net change in cash. Plug that into last year's bank balance and it must equal today's bank balance. The three statements are now perfectly linked. Let's quickly run through year one of our Apple world. We start with net profit of $30. Let's add back depreciation of $3. Remember, depreciation doesn't result in any cash movements, but it was deducted as an expense from our profits. So we reverse it. We bought and sold all apples, so no change in inventory. But customer didn't pay us $10 and our receivables increased. We have a minus $10 effect on our cash flow. But we also didn't pay our farmer for apples. We increased our payables by $5. That saved us cash, so plus $5. Operating cash flow is now 30 plus 3 minus 10 plus 5 equals 28. We wanted to save on transportation costs and bought a truck for $150. Our investing cash flow is minus $150. Our free cash flow is now negative, minus $122. How is that possible? Well, to buy a truck we took a bank loan. New bank loan was $140, plus $140 to financing cash flow. But we also generated some profits and decided to pay ourselves a dividend, minus $5. Total financing cash flow is now plus $135. Net change in cash equals 28 from operating cash flow, minus $150 from investing cash flow, and plus $135 from financing cash flow. In total, a $13 increase. If the last year's bank balance was $10, we should end the year with $23. Check your bank statement. If it doesn't match, something's wrong. What can you see from cash flow? If briefly, positive operating cash flow plus moderate investing cash flow means healthy core business which funds its growth. Negative operating, but big positive financing cash flow, lots of loans, is a red flag. Cash comes from lenders, not operations. Repeated big investing cash flow followed by rising operating cash flow in later years means smart long-term investment is paying off. So, we are through the introduction to the cash flow for today. Let's summarize it. Profit is not cash, timing matters. Cash flow statement splits into operating, investing, and financing. Cash flow can be done via direct or indirect method. Indirect method starts with net profit, then fixes for non-cash items and working capital movements. Always reconcile to the bank balance. Numbers must add up. So you just briefly learned how to track the lifeblood of any business, cash. In our next lesson, we'll practice reading a cash flow statement side by side with the income statement and the balance sheet. If this lesson was helpful, hit like and subscribe so you don't miss the next episode. See you soon!